Your deal structure matters a lot to investors, and there are 3 things you need to do to get an investor to say yes. Remember, no deal structure is gonna be good enough if you have a bad deal. I've seen this so many times. People try to get deals invested in that are just not great deals. So that's the very first thing. You need a good deal. If you come across greedy to investors, you won't get invested in. However, if you do tons of work and you can't capitalize on big wins, then it won't be worth it. So it's a bit of a delicate balancing act that I've had to learn the hard way over a lot of years. I've negotiated over 10 joint ventures with institutional investors. I've spent millions of dollars on legal with attorneys, and there's over 100-page documents on some of my JV agreements. I've really had to learn what investors will invest in and how to structure the best deal. I know exactly what professional investors will and will not agree to. Institutional capital can be great because you're only dealing with one check writer for a deal. So you don't have to, aggregate funds from a bunch of different people. You just have one decision maker that can write one check, which is really great. The con to that is there's a lot more control rights that they can enter into your deal, and they also can have a capital stack that's a lot less advantageous to you. So the smaller the check someone is giving to you, typically the less sophisticated they are. So if you're taking a $500,000 check from 20 different people, each of those people aren't going to have a say in your deal, versus an institution is going to want to have parameters around what control you have. For me, that never bothered me because they only want control if you're doing something really bad. And so I think that, as long as you're doing your job and you have a solid deal, that an institutional investor is a great option. The pros to syndicating are you can usually get better deal terms and there's a lot less, scrutiny around the deal. However, usually it's more of an emotional investor that takes a lot more time to be handheld, and they don't always understand real estate as an investment that they're making, right? They're really just investing in you, which puts a lot more pressure on you. What I like about institutional capital or even fund, getting capital from a discretionary fund is that these people are big boys and girls. They know what they're getting into. And if the market changes, they're not like personally blaming you because you're a family friend that something happened. They understand what a cap rate is. They understand, when interest rates go up, how that impacts things, and they're professional investors. I prefer that. A lot of people prefer syndicating because it's easier and you can get a lot better terms. So it really just depends on what your preference is. So after you do have a track record, a lot of people consider raising discretionary funds, meaning putting together a pot of capital that's in a fund structure so that they can invest it into essentially whatever they think is best. So it is a level up from getting someone to invest just directly in your deal. Funds to me have gone I've raised a lot of capital in the last 5 to 7 years, and funds have really fallen out of favor, I think, unless you have, a track record that's 20 to 30 years long and you're investing something that's really down the fairway. I think funds have really gone out of favor. Investors don't like paying fees on funds, and they don't like having, the loss of control rights. Like they can't really see what they're investing in the front end. For development, I don't think funds are a really great option because of the life of how long it takes to develop in the development cycle. I've raised a discretionary fund. I've actually raised 2 discretionary funds. And if you miss the timing, it can really affect the fund returns. One reason a fund is good is that if you do lose capital in one project, you can make it up with other projects within the fund. But I don't think that's really enough of given it's so much harder to raise discretionary fund capital, I don't know if that's really enough of a benefit to make the juice worth the squeeze on that one. I can give you some examples of terms on institutional JVs that I've negotiated. The largest check I ever raised was from a public REIT, and there were the most constraints around that capital. They provided a majority of the capital, but that was done in a co-GP structure so that they had the most control over the deal. And ultimately, the deal never got fully done after we purchased it because I didn't have as many rights as a developer because they were the most institutional investor I could have raised capital from. But that was structured in a sense as a co-GP where they had a lot of the control rights. So that was something that I gave up for being able to raise so much capital at once and getting, such a huge project capitalized. Another form of JV that I've done is when I've raised a discretionary fund. And that means that I pulled together several high net worth and family office dollars into a fund structure. On a fund, typically you're getting anywhere between 1 and 2 points on the total equity raise. So if you raise $50 million, you're getting, $500,000 to $1 million a year in fees on managing that capital. That's the 1 and 2 points. And then you get, say like 20% of whatever the profits are. So if you invest all of that capital, you would take 20% of the profits. I negotiated a slightly larger percentage of the profit, but that was after the investors received a preferred return on their money. So I believe our preferred return was around 10%, which is a pretty high hurdle. And I like to do that because I want my investors to feel like their capital's largely de-risked. But if I make a total home run, I want to see the fruits of that labor because I'm the one putting together, the investments and doing a lot of the work. And what I do is very pioneering compared to typical fund investments. So, there's different ways to structure it where you can give someone a higher preferred return and take a larger percentage of the back end, or you can be more on the same basis as them where you're splitting, what's called promote, like the back end profit more equally, but they're not getting as much of a guaranteed return, which is the preferred return. So my advice for this is to, one, understand who your investor is and what's important to them. You can even just ask someone, how do you like to invest, and do your research on who you're asking money for before you just go into a meeting or you throw out terms that are completely wild and off base. Secondly, you can always work with capital markets brokers or investment bankers on getting a deal funded if it's large enough, and they will have a really good sense of what market terms are for that investment category and that deal size. And if they're good brokers and they have a solid reputation, then, they'll be able to give you a lot of information when you're starting out about how hard it's going to be to get funded, what investors to take it to, and what really good deal terms are. And then lastly, especially if you're first starting out, it's always better to give your investors better term than what's market, because they will keep investing with you over time. And being greedy and coming off, as greedy is just not a good way to get your deals funded, especially in this market. It's an investor's market, and sometimes you have to be more generous than you think. I hope you found this helpful. If you want to have my advice on how to build a pitch deck for investors, please watch this next video.